there, and welcome to another episode of the Property Wealth Podcast. Today, we're diving into a topic that's really intriguing for anyone looking to invest in real estate, SBA loans.
Yeah, that's right. A lot of people don't realize how these loans can be a game changer for real estate investors, especially those who are just starting out or looking to expand their portfolio.
Exactly. SBA loans can offer some pretty favorable terms, which can make a big difference in your investment journey.
Absolutely. We'll be discussing how these loans work, the benefits they provide, and some of the pitfalls to watch out for.
And we're also going to share some practical tips on how to navigate the application process. Because, let's be honest, it can be a bit daunting, right?
For sure. But don't worry, we'll break it down step by step.
Plus, we'll touch on how SBA loans can fit into a broader real estate strategy, whether you're looking for commercial properties or even residential investments.
Yeah, and we'll also talk about real-life examples of investors who've used these loans successfully, which can really provide some perspective.
So, if you're over 40 and thinking about getting into real estate investing or expanding your current holdings, stick around. There's a lot to unpack here, and we're excited to help you on this journey.
Let's jump right in and start exploring the world of SBA loans for real estate investors. So, Sarah, one thing that's really important for our listeners over 40 is the idea of retirement timelines. A lot of folks are starting to think seriously about how to secure their financial future, right?
Absolutely, Mike. And when you think about it, real estate can be a solid way to build that retirement nest egg. But with everything going on in the economy, it's not just about the property itself. It's about how you finance it too.
Exactly. And right now, SBA loans are becoming a more popular option, especially for those looking to invest in real estate. They offer lower down payments and longer repayment terms, which is, a big deal for anyone trying to manage their cash flow as they approach retirement.
Right. And with inflation being a concern, locking in a loan at a fixed rate can really help shield investors from those rising costs, don't you think?
Definitely. Take a look at Bob, for example. He's in his early 50s and has a decent job, but he's worried about how inflation is eating away at his savings. He recently used an SBA loan to purchase a small multifamily property. It not only provided him with a steady rental income, but also a hedge against inflation.
That's a smart move. And I think it's so important for listeners to realize the emotional side of this. It's not just about the money. It's about peace of mind, right?
Absolutely. When you have that rental income coming in, it can really alleviate some of the stress around financial security. Like, let's say your neighbor, Karen, she's in her late 40s and worried about her kids' education expenses. She used an SBA loan to buy a duplex. Now she's renting out one side and using that income to help fund her kids' college.
That's such a great example. It shows how real estate can provide both financial benefits and emotional reassurance. And for many people, the idea of wealth transfer to family becomes really important, especially as they get older.
Exactly. Real estate can be a legacy, It's not just about building wealth for yourself, but for your family too. Imagine being able to pass down an asset that can continue to generate income long after you're gone.
And with the current economic trends shifting, it's essential to be proactive. The market can be unpredictable, and those who are prepared can really take advantage of opportunities when they arise.
Right. For example, interest rates are fluctuating, and while that can be daunting, it also presents a chance for savvy investors to jump in when the conditions are favorable. An SBA loan might be just the thing to capitalize on that.
Yeah, and I think it's also about understanding the market cycle. For someone over 40, they might have seen several cycles in real estate. They know that it's not just a straight lineup, but rather a series of peaks and valleys.
Exactly. And during those valleys, properties can be undervalued, which means it's a perfect time to buy. With the right financing, like an SBA loan, you can secure a great deal and set yourself up for success when the market rebounds.
And speaking of securing deals, there's the aspect of emotional readiness. It can be intimidating to step into real estate investing, especially if you've never done it before.
Totally. But having a clear strategy and understanding the benefits of using something like an SBA loan can really lower that barrier to entry. It's about feeling empowered to take that next step.
I think that's a key takeaway. It's not just about the numbers. It's about feeling secure in your investments. And as you build that confidence, you start to see more opportunities that align with your goals.
Yep. And for many people, it's about creating a diversified portfolio. Real estate can be a big piece of the puzzle, helping to balance out other investments they might have.
Exactly. And with the potential for rental income, it becomes a more passive way to generate wealth, which is so important for those nearing retirement. You don't want to be in a position where you have to work harder as you get older.
Very true. And let's not forget about the tax benefits that come with real estate investments. It can really help with reducing taxable income, which is crucial as you're planning for retirement.
Right. And I think about folks like Linda, who's in her 60s. She's been investing in real estate for years, and the tax deductions she receives have allowed her to reinvest that money into more properties.
Yes, that's a fantastic example. Linda's experience shows that with the right strategy, you can leverage real estate not just for income, but also for long-term wealth building through smart tax planning.
And as we shift into talking about core strategies, I think it's essential to emphasize that this isn't just about buying any property. It's about understanding your market, knowing your numbers, and utilizing tools like SBA loans to make informed decisions.
Absolutely. And by doing that, you set yourself up not just for financial security, but for a legacy that can support your family and future generations.
That's a powerful thought, Mike. Let's dive into those core strategies next.
So let's dive into some of those core strategies and rules of thumb that can really guide our listeners when it comes to SBA loans and real estate investing.
Yeah, I think it's so important to have those practical tools in your back pocket. What's a good starting point?
Well, one of the most popular rules is the asterisk 1% rule, NIBS. Basically, it suggests that a rental property should generate at least 1% of its purchase price in monthly rent. So if you buy a property for $200,000, you should aim to charge at least $2,000 a month in rent.
That's a pretty straightforward way to evaluate a deal, right? But what if the property doesn't meet that rule?
Good question. If it doesn't mean it's automatically a bad deal, but you might want to dig deeper. Look at the property's location, potential for appreciation, and other income sources. Sometimes a property might not meet the 1% rule, but could have lower expenses or higher appreciation potential.
Right, so it's all about the bigger picture. What's another rule that investors should keep in mind?
The asterisk 50% rule times asterisk is another one I really like. It's a quick way to estimate operating expenses. The idea is that about 50% of your rental income will go to expenses like maintenance, property management, taxes, and insurance. So if you're planning to rent that $200,000 property for $2,000 a month, expect around $1,000 of that to go toward expenses.
That's a neat shortcut. So if you calculate that, you're looking at a net income of $1,000 a month before any mortgage payments, right?
Exactly. And from there, you can factor in your mortgage payment to see if the deal still works for you. It's all about understanding your cash flow and making sure you're not over-leveraging yourself.
Speaking of cash flow, how important is the cap rate in all of this?
The cap rate is crucial. It's basically a way to measure the return on an investment property. You calculate it by dividing the property's net operating income by its purchase price. So, if that property generates $24,000 a year in income and costs $300,000, your cap rate would be 8%.
That's a solid return. So what's a good cap rate to aim for?
Generally, anything above 8% is considered good, but it really depends on the market. In more stable markets, you might find lower cap rates, like 5% to 7%, but they often come with more reliability. In higher risk areas, you might look for those higher cap rates, but you also have to consider the risk involved.
Got it. So it sounds like understanding your market is key here. What about deal evaluation checklists? How can our listeners create one?
A checklist is a great tool to keep you organized. Start with basics: property location, price, condition, and rental income potential. Then move on to financials. Calculate your cash flow, cap rate, and ROI. Also, consider the vacancy rate in that area.
Like if the average vacancy rate is, say, 5%, you'll want to account for that in your cash flow projections, right?
Exactly. And don't forget about potential repairs or renovations. It's good to have a cushion for unexpected expenses, say 10% of your budget.
Oh, that's smart. That way, you're not caught off guard if something comes up. Now, what about financing options?
Well, when it comes to SBA loans, they can be a fantastic way to finance your real estate purchases. The SBA 7A loan program, for example, can provide up to $5 million with lower down payments than traditional loans. But remember, these loans are typically for owner-occupied properties.
So how does that work if someone wants to invest in a rental property?
If you're investing, you might consider a mixed-use property where you operate a business on site. That way, you can qualify for an SBA loan while still generating rental income.
That's a creative approach. Are there any other financing options investors should keep in mind?
Absolutely. Hard money loans are another option. They're short-term loans from private lenders that can be used for fix and flip projects. They're a bit risky since they come with high interest rates, but they can be useful if you need quick cash.
So it's kind of like a bridge loan, right? You're using it to get in quickly, but you need to be cautious about your exit strategy.
Exactly. And then there are traditional mortgages, of course. They're great if you have a solid credit score and a stable income. You'll usually get better rates and terms than hard money loans.
Now, what about property types? Are there certain types of properties that are better suited for these strategies?
Definitely. Single-family homes are often easier to manage, especially for first-time investors. They usually attract long-term tenants and tend to appreciate well. Multifamily units can provide more rental income but come with their own complexities, like managing multiple tenants.
That makes sense, and I suppose commercial properties are a whole different ballgame, right?
They really are. Commercial properties can yield higher returns, but they also come with higher risks and longer vacancy periods. You need to do thorough market research and understand your target tenants.
So it's a balancing act, really. Now, I can see how all these strategies come together, but I imagine there are pitfalls to avoid, too.
Absolutely. We should definitely talk about some of those common pitfalls next. So, Sarah, one of the biggest pitfalls I see with new real estate investors is, well, over-leveraging. It's so tempting to think you can just keep borrowing more and more to buy more properties, but then you find yourself in a tight spot when, the market shifts or unexpected costs come up.
Absolutely, Mike. It's like they're chasing that dream of owning multiple properties without fully grasping the risks involved, right?
Exactly. I remember a client of mine, let's call him John. He was really excited about a property that was, let's say, a bit above his budget. He ended up taking out a loan that stretched his finances really thin. At first, everything seemed fine, but then the property had some unexpected repairs, and he found himself in a tough situation.
Oh no, that sounds stressful. So what happened next?
Well, he had to dip into his savings to make those repairs, which put him in a deeper financial hole. And that's the thing. When you're over-leveraged, even small issues can snowball into major problems.
Yeah, and those unexpected expenses can really catch you off guard. Like hidden costs that you didn't factor in initially.
Right. And speaking of hidden costs, I've seen investors ignore things like property management fees, maintenance costs, and even taxes. They get so focused on the purchase price that they don't think about the total cost of ownership.
That's so true. I think a common misconception is that once you buy the property, you just sit back and let the money roll in, right?
Exactly. And then you've got bad tenants, which can be a real game changer. A friend of mine, let's call her Lisa, had a rental property that she thought was a sure win. She didn't do thorough background checks on her tenants and ended up with a couple who paid late, or not at all.
Oh, that's tough. It must have been a nightmare for her.
It really was. She ended up having to go through the eviction process, which is not only stressful but also costly. She lost several months of rent during the eviction, plus all the legal fees. If she'd just taken the time to vet her tenants properly, it could have saved her a lot of headaches.
So what can someone do to spot those red flags early on?
Well, always check references and credit scores. And don't be afraid to ask tough questions during the application process. If something feels off, trust your instincts.
Yeah, and maybe even look into hiring a property manager if it feels overwhelming. They can help filter out those bad tenants, right?
Exactly. They're worth their weight in gold, especially if you're new to the investing game. Now, let's talk about cash flow. Ignoring it can be a fatal mistake.
For sure. Cash flow is like the lifeblood of real estate investing. If you're not careful, you could end up with a property that's draining your finances instead of building wealth.
I had another client. Let's call him Tom. He bought a property that looked great on paper. Good neighborhood, solid rental potential. But he didn't account for the fact that the property had high maintenance costs due to its age.
So he was losing money each month?
Exactly. He was so focused on the potential appreciation that he didn't pay attention to the cash flow. By the time he realized it, he was already in over his head.
Wow, that's a tough lesson. It must have felt overwhelming for him.
It was. The key takeaway is to always calculate your cash flow before making a purchase. Factor in all your expenses and make sure you're still in the green.
And that's where the pro forma comes in handy, right?
Yes. A good pro forma can help you project your income and expenses accurately. Just make sure you're not being overly optimistic with your numbers.
Another common mistake is trying to time the market. People think they can buy low and sell high, but that's really unpredictable, isn't it?
Absolutely. I remember a couple who were waiting for the perfect time to buy. They kept watching the market, hoping for a dip. Meanwhile, they missed out on some great properties because they were trying to play the timing game.
It's really hard to predict market trends, and by the time you think you know what's happening, it might already be too late.
Exactly. It's better to focus on solid investment strategies rather than trying to time the market. Make your decisions based on your financial goals and the fundamentals of the property itself.
And that leads us back to the importance of doing your homework. Research the area, the property, and the numbers.
Totally. And don't forget about the long-term growth potential. Short-term fluctuations shouldn't dictate your strategy.
So, Mike, what are some practical steps someone can take to recover from these pitfalls if they find themselves in a tough spot?
Great question. First, take a deep breath and assess your situation. Look at your cash flow and expenses critically. If you're over-leveraged, consider refinancing or consolidating debt to ease the burden.
And if someone has bad tenants?
They should evaluate their lease agreements and understand their rights as landlords. It might be worthwhile to consult a property management service or legal advisor to navigate through the eviction process if needed.
And for those who might be waiting to buy, it's always better to act when you're ready, rather than waiting for the perfect moment, right?
Exactly. Focus on your own financial readiness and the properties available to you. Trust your research, and don't let the fear of market timing hold you back.
Such valuable insights, Mike. It's all about being informed and making smart, calculated decisions in your investing journey.
Absolutely. And remember, investing is a marathon, not a sprint. It's about building wealth over time, not chasing quick wins.
Well said. All right, let's dive into some next steps for our listeners.
So let's dive into some immediate steps that our listeners can take right now. To get moving with SBA loans for real estate investing.
Absolutely. I think the first thing folks should do is really understand what an SBA loan can offer them. It's crucial to know the ins and outs before jumping in.
Exactly. A good starting point is to check out the official SBA website. It has a ton of resources, and you can find specific details on different loan programs. Plus, they provide a list of approved lenders, which is super helpful.
Right. And once you have a grasp on the basics, I'd recommend looking into local banks or credit unions. They often have specific programs tailored for real estate investors, and sometimes they're more flexible than larger institutions.
Yes, and don't forget about networking. Connecting with local investors can be invaluable. They might have insights into lenders who are easier to work with, or even tips on what paperwork to prepare.
That's such a good point, Mike. Joining a local real estate investment group or meetup can really boost your knowledge and confidence. You can share experiences and learn from others who've walked this path.
For sure. And while you're at it, set a small goal for yourself. Maybe commit to analyzing one deal per week, just to get into the habit of evaluating properties.
I love that idea. And using tools like the Bigger Pockets calculator can make that process a lot easier. It's super user-friendly and helps you crunch the numbers quickly.
Oh, definitely. And if you're curious about rental prices in your area, Rentometer is a great tool to check out. It can help you gauge if a property is priced right for the rental market.
And if you're looking for comparable sales, don't overlook Zillow or your local MLS. Those platforms can provide a wealth of information on recent sales, which is crucial for understanding market trends.
Absolutely. Plus, another great resource is the Bigger Pockets podcast. They have a ton of episodes that dive into real estate strategies, and you can find one specifically about SBA loans.
Yes, and there are also some excellent books out there. The book on rental property investing by Brandon Turner is a classic and covers a lot of ground, including financing options.
That's a great recommendation. And for those who are just starting, I'd suggest reading Rich Dad, Poor Dad by Robert Kiyosaki. It really shifts your mindset about money and investing.
Totally agree. Mindset is key. And speaking of mindset, it's important to remind ourselves to start where we are. Don't get overwhelmed by the bigger picture. Just take it one step at a time.
Exactly. Small, consistent actions lead to big changes over time. Maybe start by setting aside a little time each week to research or analyze properties.
That's right. And don't hesitate to reach out to professionals, like real estate agents or financial advisors, to get their take on your plans. They can provide guidance tailored to your situation.
Yes, I think sometimes people hesitate to ask for help, but leveraging the expertise of others can really accelerate your learning curve.
Well said. And for anyone who feels a bit lost, consider using a tool like DealCheck. It helps you analyze deals and even project potential cash flow and ROI.
Great tool. Also, keeping a journal of your progress can be helpful. Documenting your experiences, thoughts, and what you learn each week can provide clarity and motivation.
That's a fantastic idea. You can look back and see how far you've come, which is always encouraging. Plus, it helps you identify any patterns or areas where you might need to adjust your approach.
Exactly. And let's not forget about setting up alerts on those property websites. You can receive notifications when new listings that meet your criteria come up.
That's such a useful tactic. Staying on top of the market can give you an edge, especially in competitive areas.
And speaking of competition, don't shy away from looking into the potential of multifamily properties. They can be a great way to start building your portfolio and generating income.
Yes, multifamily properties can provide multiple streams of income, which is always a bonus. Just take the time to analyze the numbers and ensure it fits your investment strategy.
Absolutely. It all comes back to doing your homework and being prepared. That's how you'll feel more confident when you finally make that leap.
So those are some practical first steps. Now let's bring this all together.
Well, Sarah, as we wrap up this episode, I think it's important to highlight some key takeaways from our discussion on SBA loans.
Absolutely, Mike. One big point is that SBA loans can really be a game changer for real estate investors, especially those just starting out or looking to expand.
Right, and the flexibility in terms of down payments. That's something that can really ease the burden, isn't it? They often require lower down payments compared to traditional loans.
For sure. And then there's the fact that these loans can cover not just the purchase of the property, but also renovations. That's a huge advantage for investors looking to increase value.
Exactly. Plus, we touched on the importance of having a solid business plan. Lenders want to see that you know how to make your investment work.
And let's not forget about the long-term benefits of building relationships with lenders that can open doors for future investments.
Yeah, it's all about creating that foundation for sustainable wealth through real estate.
So true. Building wealth isn't just about the money. It's about creating opportunities for yourself and your family.
Definitely, and if you're over 40 and thinking about diving into real estate investing, remember that it's never too late to start. Take those steps, educate yourself, and don't hesitate to reach out for help.
If you found today's episode helpful, we'd love for you to like, subscribe, and maybe even drop a comment about your biggest takeaway or any questions you might have.
And share this episode with someone else who's looking to invest in property. You never know who might benefit from this information.
Yes, and just a little sneak peek for our next episode. We'll be diving into life insurance premium financing for property buys. It's going to be a fascinating topic.
I can't wait for that one.
Me too. Thanks for joining us today.
Take care, everyone.
Until next time.
you.